and I'd say more likely than not that silver will continue to see higher prices as the industrial users who are relatively price insensitive. You can't stop producing cars just because the price of silver's gone from $50 to $150. I mean, what is it, $80? But you're not going to say, oh, I'm going to stop the production line while I wait for the silver price to come down. You're not going to do that. So the demand is relatively price insensitive. The supply is relatively insensitive to the price because most of the we've seen a higher silver price, but the mine production has still gone down. So what are we looking at? We're looking at silver, which is being mined as a byproduct mostly of other metals. The easy mining has mostly gone, which basically means that any increase in supply of silver is going to be from the mines is going to be very marginal, which means that deficit is going to continue growing. In my opinion, and a growing deficit means that you've got to have a higher price to suck out the above ground silver. First of all, any kind of geopolitical event makes people feel nervous. And when people feel nervous, they retract and try and get back into something they understand nice and easily, which is generally cash or treasury bills. So we're seeing falling markets, and we're seeing falling precious metal prices, and we're seeing falling cryptocurrencies too. This is normal behavior, and sometimes it lasts for a while, sometimes it's very quick and very quickly over. And I'm of the view that it'll be the decline will be swiftly over, and I think we will go back up again because people are going to get itchy fingers. They're going to be back in cash. They're going to be saying this war is going to cost a lot more in terms of debt and so forth. Not that we weren't already on a path to destruction, but the debt is unsustainable. Just brings about the ending a little bit faster. So people are going to say, "I got to take this cash I've got from selling things," and they're going to go back into the market sooner or later. But that's kind of my take on it. I don't have any. I always avoid political views. I don't want to make a view as to who's right, who's wrong, or whether this is justified or not. All I can state is the facts which are going on is that there is a situation. There's a lot of people feeling at risk. Many of those people who feel at risk would rather be going to work and looking after their kids than worrying about what's falling out of the skies. And they don't really care much about the politics. They don't hate their neighbours. Or their neighbouring country even. They just want to get on with their lives. But while this is happening, they're feeling scared, so they're drawing back into cash. I must have dollars or what in my current account, and things are getting sold. But that will pass. That will pass, because just like with the Ukraine war, we had exactly the same reaction at the beginning of the Ukraine war, and then after a few weeks, people still say, "Okay, well, not much is happening to me," and then they go back to normality. It could be statistically that doesn't make sense. I've been investing money for 50 odd years in the stock markets, and I would say every year and probably every month and maybe even every day, I could easily find some excuse as to why things are going lower and should keep going lower, or they're too high and they're about to turn around and go lower. There's always some new event, some political crisis, some situation going on somewhere, whether it be a recession or a war or an election, which leaves people uncertain. And therefore, if you want to find a day when it's going down and it's going to go down further, there'll be a few of them, but very, very few of those occasions turned into serious crashes. I would say over the 50-odd years I've been investing, perhaps I could remember 5 of them when it was a serious down. I mean, I remember a day many, many years ago, must be 20 or 30 years ago, the Dow plunged 500 points in a day, and it seemed like a lot. But guess what? It turned around on a 6 months and went straight on up to another all-time high of 8,000 or 10,000, whatever it was, and now we're at 50,000. Well, we're below 50,000 now, of course. So yes, it could be, and it feels like it. It feels like we're going lower, and there's a lot of reasons I think we should, because the mainstream stocks, which make up the bulk of the US indices, are, I won't say they're extremely priced, but they are quite expensive by historical standards, and quite expensive means there's further to fall if they choose to go down. We're certainly not at the cheap end of the market. Let's just deal with a few simple facts. First of all, COMEX continues to be drained of silver. Silver is leaving COMEX. It's also I think we're at the lowest level in years. It's also leaving the LBMA. It's about half the level about 4 years ago. And it's also leaving Shanghai, the silver exchange. So where's it going? Well, it's being consumed. And the reason it's being consumed is because the electronics industry is demanding more silver than it's ever demanded ever before. We've had a decade of rising silver demand, much of which is coming from the electronics industry. We've had a decade of falling silver mined production. 4 or 5 years ago, we went into a situation where we passed from surplus to deficit, and the deficit every year now is growing larger and looks like it will continue to grow larger. So the difference between mine supply, which is falling, and industrial consumption, which is rising, that negative gap is getting bigger and likely to continue getting bigger for as far out as the eye can see. So the difference has to be met from above ground stocks of silver. And yes, if you ignore the falling supplies on COMEX and LBMA and elsewhere, there's quite a lot of above ground silver, but there's nowhere near as much as there used to be. It's getting less. And as it gets less, you need to offer those who hold that silver an incentive to unload it. And the incentive is a higher price. So everybody has their price. And, the surge in price we saw from, let's say, below $50 to over $100 at one point at the end of January was one of those surges which made an awful lot of people think, that's higher than the price I would have sold at. I'm out of here. So a certain amount of silver came and met the demand. But the evidence is that silver is which came out, is still being consumed because we're seeing the supplies at the various futures exchanges dropping. So that nothing has really changed relating to the fundamentals of silver. And I think that it's quite possible, and I'd say more likely than not, that silver will continue to see higher prices as the industrial users, who are relatively price insensitive, you can't stop producing cars just because the price of silver's gone from $50 to $150. I mean, it's what is it, $80? But you're not going to say, I'm going to wait, stop the production line while I wait for the silver price to come down. You're not going to do that. So the demand is relatively price insensitive. The supply is relatively insensitive to the price because most of the we've seen a higher silver price, but the mine production has still gone down. So what are we looking at? We're looking at silver, which is being mined as a byproduct mostly of other metals. The easy mining has mostly gone, which basically means that any increase in supply of silver is going to be from the mines is going to be very marginal, which means that deficit is going to continue growing. In my opinion, and growing deficit means that you've got to have a higher price to suck out the above ground silver. When something is rising in price, there's always going to be people who want to get in the news by making a projection which is away from the crowd. And he might be right, but we've seen. I don't think they still do it, but if we go back a long time ago, the Wall Street Journal every year would publish a list of 30 or 40 or 50 analysts on where they saw indices like the Dow Jones and the Nasdaq. And every year after the year had finished, I'd go and look at where the bulk of the analysts lay, and typically the market finished different from where the consensus was by about 30%. Well, I say often by more than 30%. In other words, they thought it was going to be up 12%. Then the market would be up 42%, and they thought it was going to be up 12%. The market could be down 20%. In other words, they were 30% away. So it's fun for analysts to put a number on the game, but sometimes they can be very, very wrong. If the guys say it could be $160 an ounce, well, I believe that's possible, but it might get. I can't exclude that it's not going to go to 300 or 500. That's possible too. Now, I'm not forecasting it. I don't forecast things like that. But if I was going to forecast a price, I'd try and stick quite close to where we are now. That's what the wise analysts do. But the ones who want to get in the news will go out on a limb and forecast a very high price. Now, I do think it makes sense that it would go higher, but how fast and how squeezed it gets, you just don't know, because things can play out in many different ways. I wouldn't want to be a short in silver right now. Let's put it that way. I think that would be a dangerous bet. The supply and demand, as I said, are very inflexible. This is not oil. I mean, if the demand for oil goes up, they could just pump at twice the speed. That's an easy thing. You can't dig the silver up at twice the speed. It doesn't, it doesn't work like that. You can only get out so many tons of silver per day or per week or whatever it is. So what it comes down to is the demand and the supply. Now, I believe that what happened towards the end of January was a lot of consumers of silver, factories and so forth, who were manufacturing solar panels or electronics or whatever else, they became quite nervous and decided to stock up on something a little bit more longer, a bit more silver than just-in-time silver. So a lot of them would have relied on just-in-time supply chains, and then they're seeing and hearing the price of silver's going up, the silver supplies at COMEX are going down. What if we can't lay our hands on our traditional supply from our traditional source when the time comes? You know what? Let's buy a bit more just in case. And I think that was one of the things which probably accelerated the move upwards. And now we've had, as a result of that rise, this catastrophic fall for many, where we come down from nearly $130 to 65 at one point. Now we're around 80, I believe. 82 perhaps it is today. You'll know better than I, Elijah, because it's literally been very, very volatile all over the place. You blink and the price is $2 different from when you looked before, and it could be in either direction. So I think perhaps now it's come down. Many of the consumers of silver feel less concerned that COMEX I won't say COMEX. Less concerned that their traditional supplies of silver are going to dry up, because obviously some silver must have come out of the woodwork to drive the price down. The other comment I'd make is about the silver shorts. We've always had in the silver market the shorts. These are big bullion banks, and it's quite a legitimate play. Technically they're probably not uncovered because they got silver in place A, and they're doing the shorting on the futures exchange like COMEX. It's a nice, easy way to make money over and above your treasury return, because provided you've got the collateral to meet the minimum margin requirement, your collateral can be earning interest whilst at the same time you're selling a 3-month future, waiting for it to get a spot month, and the 3-month future is selling at almost always a higher price than the spot month. That's called the contango. So not only are you making it on your money market or your treasury bill that you've got as collateral, you're also making it by constantly rolling over these futures. And from an economic point of view, you probably feel you don't have any risk because you've got the silver stored in London. And again, that might be earning as well, because perhaps on your behalf, they're lending it out and earning a fee for you as well. So the amount by which these bullion banks can go short is unlimited. But of course, when the price starts rising, then they start to say, oh my God, can we get the silver from place A to place B? And we heard these stories about the smelters being backed up and unable to convert the London size bars into the 5,000 ounce bars needed in New York. And suddenly they although they're financially covered, they got the silver in place A and they need it in place B. Converting to the right, moving from A to B and getting it to the right size bars is not as obvious not as delay free as they thought. So there was probably a little bit of panic amongst the silver shorts, many of whom were rushing to close their near-dated contracts, driving up the price as well.